Welcome to the Nichols Tax Update Podcast, issue 2149, as we approach the holiday season for 2021. This program is produced to provide current information about developments in United States tax law, and the disclaimer continues. But what's most important is that I acknowledge the value in preparation of this program of my subscription to Tax Notes Today, published by tax analysts. It is, in my opinion, the preeminent source of information for tax professionals who want to be up to date on current federal tax developments. Let's start this week. We have 5 items. We would have 6 if the the Reconciliation Act of 2021 could somehow get passed, but the House Ways and Means Committee and the Senate Finance Committee are trading versions of the bill, and so we don't really have anything to report. So we'll report on what we have. Calculating imputed underpayment of partnership tax liability. We'll talk about, what, a partnership with a tax liability? Yes, in case you missed it. And then guidance on September 30th termination of the employee retention credit when some employers had already claimed the credit in advance. Next, partnership challenges the self-employment income adjustment by the IRS to its income reported to its members, who it believes should be classified as limited partners and therefore subject to Code Section 1402A13 limitation on self-employment income of a partner and how that would be calculated. Next, proposed regulations on the beneficial ownership of a U.S. business entity, 188 pages. And this is a big deal. It is intended to stop the use of U.S. business entities for fraudulent purposes because we haven't paid enough attention to who are the beneficial owners. That's about to change. And finally, the IRS asserts the 75% civil fraud penalty in 9 new tax court cases on the charitable contribution deduction for an easement, for the contribution of a conservation easement. It's an interesting array. Let's get started with this advice, this Chief Counsel memo on how a partnership should calculate its imputed income tax liability. Remember the Bipartisan Budget Act of 2015, and be careful because there are bipartisan budget acts of 2013, 2015, 2016, and 2017. You want to make sure you get the right one. It made partnerships taxable entities unless they elect out or they are small partnerships. The guidance given here is only notable for this phrase. After explaining adjustments that affect a partnership's imputed underpayment, and the acronym for that is IU, here's a quote. So if you want to adjust the partner's outside basis, that would be done outside of BBA. This is all a quote, parentheses, I did this in red. If you are going to do this, call me. What? The good folks at the IRS are not sure on the firing line how to do some of the things they're supposed to do, and so they're not putting any guidance in writing. The guidance is in a phone call. If you're going to make this kind of adjustment to the partnership, to a partner's outside basis in connection with adjusting a partnership income, call me and I'll explain to you on the phone how to do it. I read this stuff every week. I share it with you just as it comes to me. Next, the employee retention tax credit was terminated, as we know, as of September 30th, 2021. That was a surprise. It was supposed to run through the 4th quarter of 2021. Notice 2021-65 gives us guidance for employers other than recovery startup businesses who can continue to claim the employee retention credit through the 4th quarter of 2021, but they're the only ones that can. The employers are no longer entitled to the employee retention credit for wages paid on or after October 1st. If an employer requested and received an advance payment of the credit for wages paid in the wages to be paid in the 4th quarter, then, and you're not a recovery startup business, you have to give the money back. And you have to do that by the due date for the 4th quarter employment tax return. Further adding to the surprise, The IRS will not waive failure to deposit penalties for employers that reduce their deposits in anticipation of the employee retention credit unless the employer is a recovery startup business. So you had no right to the fourth quarter payment, but you didn't know that when you requested the advance payment. But now you have to give it back, and you have to give it back no later than the due date of the payroll tax return for the fourth quarter. Speaking of partnerships, we seem to be concentrating on partnerships this week. Serious Solutions is contesting a partnership adjustment of its income to be classified as self-employment income. This is a really big deal, which is why I have it in all caps. Classification of an LLC member's share of distributable income as subject to self-employment tax is a big deal. The partnership here is challenging a notice of final partnership administrative adjustment, and they contend the IRS erred by adjusting its net earnings from self-employment for 2 tax years, adjusting its net earnings to be as from self-employment, and determining that the partnership's individual partners are not to be treated as limited partners. Why is that classification so important? I thought I might explain that on one more slide. Code section 1402A.13. There shall be excluded from the distributive share of any item of income or loss of a limited partner as such, other than guaranteed payments described in section 707C, to that partner for services actually rendered to or on behalf of the partnership, to the extent that those payments are established to be in the nature of remuneration for those services. None of the partners of Sirius provided any services that were any different from any other. All the services were provided by employees, and the income was earned principally for for technology, not for the service. Nobody was working. There was no one showing up for 40 hours a week to earn their money. So when the LLC member is treated as a limited partner, which can be any and all times, why is it important? I mean, I happen to believe that the LLC member is first, last, and always a limited partner. It's that self-employment income thing. If the limited partner's share is related to services rendered by the partner, no doubt it's subject to self-employment tax. If not, it isn't. And that can be a really big difference. In this case, it's 2.9% of $7,863,000. That's $228,000 out of the partner's pockets. So you see why that's important. What created the income? Was it the labor of the employees? Was it technology? Was it capital invested? If it was not, clearly the labor of the LLC member. The IRS has yet to win a case in which they classify the income of a limited partner as subject to self-employment income, where that LLC member, treated as a limited partner, did not provide substantial services which are related to the amount of the payment in the form of a guaranteed payment or clearly traceable to payment that partner got that no other partner got. The IRS will trumpet this as a victory if they win it. It isn't. It's only a small piece of the problem, piece of the issue. Well, then it gets worse. 188 pages. Regulations implementing the Corporate Transparency Act. Our lawmakers awakened to the fact that our business system was being overtaken and overrun by sharp operators who used the lack of transparency in our corporations and our partnerships to shield themselves from discovery, from liability, and to conduct evil doings. A domestic reporting company under these 188, if I can give you an executive summary in one paragraph, a domestic reporting company is one registered in doing business in the United States. They have to register and report. A foreign reporting company is one registered under the law of a foreign jurisdiction, but also registered to do business in the United States. There are 23 specific exemptions, and you can find them in the executive summary of this 188 pages that appeared in the Federal Register on December the 7th and December the 8th, 2021. The bottom line is the IRS gets to know who you are, and they get to know who owns a business, who are the beneficial owners. We talked about that a couple of weeks ago when I explained the changes in the Form SS4. And now about that 75% civil fraud penalty, which is newly proposed by the IRS. IRS is fighting the promoters of the contributions of easements that are overvalued, that are under restricted. So this article on Tax Notes Today by one of their staff writers, Kristen Perillo, writes very well, by the way. Tax fraud is a deliberate attempt to evade taxes or defraud the IRS. We get that. Tax fraud takes place when a person or company willfully does one of the following: intentionally fails to pay taxes owed, willfully fails to file a federal income tax return. These hotshots file all their returns, fails to report all income. That's not a problem here. Claims false deductions. Well, maybe, but then misrepresents material facts. If you misrepresent the value of the property that you're contributing, that's a material fact. If you misrepresent the restrictions that are placed on that value, that's a material fact. It is more than an error in judgment or a mistake in filling out a form. The IRS clearly believes that most of the promoted easement contribution cases involve intentional misrepresentation of material facts. And the 75% addition to the tax assessment that will apply, so it's going to be 100% of the tax plus 75% of that amount plus penalties and interest, could be more than the original amount of the tax, should apply. I can't argue with that, and I would not argue with that. It's high time the IRS shut the promoters down and made the attempts to get bogus tax deductions extraordinarily expensive when you fail. Well, until next time, I appreciate your time. Thanks for supporting this podcast. Stay safe. We need each other.